Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with Dara Shareef of Benchmark International. Nicholas, what was a takeaway you had from our conversation with Dara?
Dara talks about how one way for the seller and the intermediary to retain control once the LOI is signed is to design a timetable and create milestones for the process, the post-LOI process. And they very much invite the sponsor or buyer to set and establish those milestones in the timetable. And that way the buyer is effectively held accountable against their own timetable throughout the process. And for you as a seller, then this becomes a tool to keep the pressure up a little bit on moving the deal forward. As I was thinking about this, I thought this was a useful tool for sellers, but it's actually also a useful tool for buyers. And it's a good way for a buyer to show organization and retain control as well. And so I would encourage everyone to include a tentative timetable of here's when we're going to kick off this and that part of the diligence already in the LOI. And so what could that look like? What would typical milestones be like? And we don't necessarily get into the details here with Dara today, but in my experience, a couple of the things that you do right away after signing an LOI would be to schedule a kickoff meeting. This might not be a very meaty meeting. There might not that be much to cover 3 days after you've signed an LOI, but for a seller who's just signed an LOI, that's a big decision point, a big inflection point, a big moment for them. So emotionally, it feels good for them if they instantly get the feedback of, oh, let's get a kickoff meeting in the books and get the process started. And usually they'll bring at least an advisor, maybe even a team member to this meeting. So that kind of gives you an official starting point, so to speak. And then you can start also weekly recurring meetings, which I think are smart. I would suggest 60 minutes on the calendar, same time every week between a buyer and seller. Some weeks you won't need the time at all. You just say hello and say no progress this week. Other times you'll use the whole hour, but it's just good to have a recurring touch point because otherwise suddenly 15 days have passed since the last update, and that connection and relationship is really the most precious thing in this process. I would also say right out of the gate, once you've signed an LOI, you should send an extensive data request list. And then I'll post on LinkedIn about other milestones that I think you should include here. But engaging a QOV provider, Dara talks about how spending real money very soon enhances your credibility as a buyer, and the seller wants to see that. And I know this from being on the exiting side of a deal as well. Once you see your buyer rack up bills, legal bills, QOV bills, it gives you some confidence that, yeah, they're still serious and they're moving this in the right direction. Also, spend time on the ground, schedule visits for your diligence providers as necessary, and also capital providers as they come into the picture as soon as you can. And show that you have momentum at all times. And for that weekly recurring meeting, bring something every time if you can. That, hey, in the past week, we have checked this box and moved this forward. Here's what we need from you now. And move things. And time is of the highest essence, and just have mad urgency once you're under LOI.
Great. On the point of building credibility, yeah, that is something that comes up as it often does when talking about independent sponsors. It'll be a familiar theme to listeners. First and second time sponsors, of course, need to project that they can close, and so that's a theme that we hit on. And Dara talks about it's not the difference between having done one deal and zero. It's usually 2 and 3 deals where he starts to really believe that where the number of deals starts to count. Because if you've done one deal, it might have just been luck that first time. So he likes to see 2 and 3 and up. I'll mention the segment with Dara about where he talks about his own putting himself out there. Dara is a very charismatic stage presence, and he is putting himself out there. I mean, he's proactively getting on stages. Nicholas, in fact, found him for our own virtual stage here because he was on stage at the Miami Independent Sponsor Conference earlier this spring. We talk about that, and I think he said this was his kind of second round of doing this in his career. He'd done it once before, and he's kind of now back at it. And the value of doing it and the doors that it opens for you, and how to go about it for people who've never put themselves out there. It can feel self-promotional. It can feel intimidating if you're not used to seeing yourself out there, or kind of being the guest, being on a stage, either virtual or real. And we talk a little bit about the tactics about how to go about it. You can start with smaller stages, smaller conferences or smaller podcasts, and work your way up. I know this point might sound self-serving because here I am, somebody who tries to recruit independent sponsors for our podcast, and we are always looking for good guests. So please, any independent sponsors. But I do believe in content as a door opener and as something that can really create value in one's career. You guys can certainly attest to that. And I also, just tying it specifically to independent sponsors, if nothing else, by appearing on a podcast, either ours or others, it does give you this artifact that you can point to when communicating with sellers. Often we talk about, with our guests, the sponsors, the philosophy of their firm, how they approach sellers, how they approach the investments. And this is all valuable information that a seller would love to hear too. So by having appeared on a podcast and having sort of the third-party credibility of that, you can direct a seller to that when you're in a negotiation and say, hey, to learn a little bit about me, I was on this industry podcast. Give this a listen. And that alone can be worth the hour or two that it takes to appear on a podcast. But I think there's really so much more. And so I thought that was a fun to hear about a guy who's proactively going after this strategy and how he's gone about it and recommends it for others. Max, what did you think of Dara?
It was fun. It's always fun to hear the deal perspective from a banker or a broker, just because they're involved in so many transactions. They deal with so many different sellers and so many different types of buyers. And so I think Dara went into some good tips really for independent sponsors on how to stand out in the deal process. And I think in reality, these super A-class assets, I think if they're being banked or brokered, I think that intermediary ideally is hoping, of course, to sell for the highest price to a strategic or potentially a PE fund. So, Dara goes so far as to say that, of course, independent sponsors can compete on any deal, but realistically, they're probably going to have the best chance where there's a deal that has a little bit of hair on it, which we all know. And in that regard, it kind of struck me that, just overall in these processes, it's not just one sale. It's not just the seller selling the company. It's actually, in many cases, it's an intermediary selling his or her skill set to the company first to represent them. And then it's the seller and the intermediary selling to potential buyers and, trying to present their business in a credible way to attract a market. And then it's the buyer selling themselves to both the intermediary and the seller to show that they're the best steward for the business going forward. So you have all these sales happening, and really the common currency of that is confidence and credibility. Because as soon as either any of these three parties sort of lose credibility or break, one of the other parties' confidence in them, the deal just falls apart. So I found that to be really interesting. Just the fact that the seller's got to bring credibility that the business financials are accurate and that the business is going to be great on a go-forward basis. They've got to convince that buyer, and then the buyer's got to convince them, of course, that they're the best person to buy the business. And ways in which this credibility can be impaired, if you think about it from an independent sponsor standpoint, it's missing deadlines. It's coming to meetings with low energy. It's not having the transparent, tough conversations up front. And I think as soon as this credibility, starts to slip at all, that's where these deals fall apart. So it's really important to build that credibility. And as you talked about, if you're a new sponsor, build it early with podcasts and things and artifacts, like you said, Will, that you can point to, but then maintain that credibility throughout the deal process. And that's how you get a deal done. And I would just add this low energy concept. I think we see it time and time again where we're excited about a deal, but sometimes one of the parties, comes to us with low energy in a meeting. And, it just, even if it's a great deal, sometimes that can sort of be enough to shake our confidence in the deal.
Great point. Well, before we turn to Dara, a reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 million to $3 million. We average about a commitment a month. So if you are a sponsor raising equity for a platform acquisition, submit your deal to us via our website at mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's also a pre-registration form on our website for investors. So if you are accredited or can become accredited, fill that form out to be kept in the loop on our future raises. Again, mindscapital.co. And here is the Minds Capital podcast interview with Dara Shareef of Benchmark International. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James.
Newly acquired and PE-owned companies are high-value targets. Hackers time their attacks when teams are distracted by the deal, exactly when a breach can stall operations, bleed cash, and blow the thesis. Enzo Technologies is your full-service IT MSP for post-close stability. They assess your target, surface the biggest risks in plain English, and give you a day 1 through 30 plan to cut exposure, prevent downtime, and even find cost takeouts like bloated telecom bills. Check out enzotechnologies.com, INZO, or email CEO Nick Akers directly at nick@enzotechnologies.com. Having acquired Enzo himself, Nick understands the challenges sponsors and searchers face when transitioning a business. So make sure to tell him you're an independent sponsor and listener of the Minds Capital podcast. nick@enzotechnologies.com.
Based in Tampa, Florida, Dara Shareef is a member of the Global Board of Directors, a shareholder and podcaster with Benchmark International. Benchmark is a powerhouse in the lower middle market M&A space. With over 350 deal makers, Benchmark is one of the leading global brokerages for existing business owners. Dara has a background in VC, C-level operations, and M&A across the capital stack. And at Benchmark, he has the perfect vantage point to understand the nuances of the independent sponsor model and how independent sponsors interact with the lower middle market. Dara, welcome to the Minds Capital podcast.
Yeah, thanks, gentlemen. I'm excited to join you today.
Dara, in our pre-call, you characterized the work of bankers as that of a translator. What did you mean?
What a great place to start. So I think especially in the lower middle market, there's a huge gap in what buyers require and what sellers are able to furnish. And I think a lot of it has to do with knowledge and how they characterize things. And I think I might have mentioned in our prior call, one classic example is a buyer will ask for AR aging reports. And our clients are going to say, wait, what is that? And not only will they ask the question, they'll be offended you asked it because they think now they look like they don't understand their own business. So what we have to do is just go ahead and say, well, we tell the buyer, here's how you ask that question. It's a different language. Buyers and sellers will speak different languages. What they're asking for is, what's your billing cycle look like? Hey, you put bills, how quickly do you put your bills out there? How quickly do you collect? It's a cash flow management issue. That's it, right? So once you sort of teach the buyer how to ask the question appropriately and teach the seller what they're trying to actually accomplish, you sort of grease the skids a bit and the conversations get a lot better. But oftentimes you have to funnel those conversations through a middleman who speaks both languages.
And the buyers who speak with the vocabulary of private equity and high finance or a more sophisticated academic approach to business operations, how often do you see that? I mean, how many buyers have this problem that they need to be translated?
Yeah, so I think over the course of time, you start to learn, right? So a seasoned buyer who hasn't moved upstream. So someone who's been in, sort of that doing deals that are, say, $10 to $100 million, say, we'll call that the lower middle market. Those who've been operating that market for a long time, they understand these are table stakes. Like this is the language of the lower middle market business operator. So over time, they do tend to, sort of learn that different language and how to characterize it. And then it just sort of comes down to how stubborn they are, right? And how much they want to be right versus how much they want to, sort of actually get a communication, flow going with a prospective seller. So, even with people who are really seasoned, sometimes we have to step in and just sort of serve that purpose. But then there are the folks who really, sort of have come from that world, right? And they do know that language and they speak in that language. So they're not trying to impress you with their vocabulary. They're trying to establish, communication.
Great. Well, Dara, on this topic of communicating with sellers, Benchmark, you all probably connect with more business owners than most anybody else. That sounds like an overstatement, but with 350 brokers and bankers, I'm not sure it actually is. What's some of the secret sauce of actually getting the audience of sellers in the first place and having them take you seriously? That deal flow, of course, is what everybody listening to this podcast struggles with. You're kind of doing the same motion, but presumably you guys are more successful at it.
So I would say that we're not actually doing the same motion. I think that's the key. So, the traditional approach to sourcing deals in investment banking is to establish relationships with wealth managers and other folks who interact with business owners, and then establish sort of like cross-referring patterns, right? And that's how they source their deals. And while we do that, and I think we met at a panel that I was on, so we certainly do that. The vast majority of our deals come in through our dedicated origination team. So we've bifurcated the traditional process of sourcing deals and executing on deals. So we have just an origination team, and all they do is originate deals. And then we have an execution team or a transaction team, and all they do is transact. So we get very hyper-focused and we stay in our lanes. So the origination team, they're very data-driven. Right. So, 15 years ago, we were making a lot of phone calls, right? It was almost a sort of a smarter call center. Now we certainly make phone calls. We do email campaigns. We create a lot of content. I mean, we'll talk about the podcast that I'm doing, which is, a content creator. We do webinars. And so we create content, we send it out to the world, and we follow up with the folks who are interested in the content we create. So it's a very sophisticated engine with sales sequencing campaigns and all the modern sort of approaches, SEO, we're doing GEO and all the, AIO and all that sort of intellectual sort of approaches to campaigning. So it's very different than the traditional methodologies. We do what the others do, but the vast majority of our deals for our entire existence come from a totally different approach.
And generally, when you're doing this, the marketing, maybe it's the topic of a webinar, maybe it's a cold email. What is the hook? Is it learn what your business is valued at today? That's kind of the cliche hook, but maybe it works. Or is it how to start planning today for your exit 5 years from now? Is it something along those lines, or is it state of the market? Am I even in the ballpark? What does it look like? How do you get the attention of these sellers, these owners?
Yeah, yes is the answer. So it's every version that you spoke of and many, many more. So we'll dial it in to the point where we're talking about industry specific information. So if they service compressors and pumps, we're going to feed them information that we've created that tells you sort of, or mandates we've gotten from buyers. We speak to more buyers than probably anyone on the planet. So we do have a bunch of mandates from buyers, even though we work for the seller. So we use that sort of information, very specific to their industry, or if they're sort of, in broader macro trends, so we might draft a white paper or put together an article. I've drafted a lot of our original content. And so as, other members of our team, and we'll send that out to folks and they'll express interest and they'll want to engage with our content. So that's really it. It's not, so I get a lot of these cold emails, these campaigns from, some of the folks who do this, and they are very basic. So what you've described, what is your business worth? It's kind of trite. There's not much behind that. And so I don't think you get a lot of engagement with that kind of, we're not averse to that as a part of our strategy, but we do try to give them something for free. I think the best way to demonstrate value is to give it to them before you've asked them for anything in return. So we do a lot. We create a lot of value up front, and then, it becomes easier for them to sort of engage with us at that point.
And so this podcast,
Yeah.
that is a recent development, a recent initiative. Where does this fit in on the whole? On cue. What's it called there? I didn't quite catch the name.
It is called Closing Remarks.
Closing remarks. Great. How does that fit into the marketing strategy? Is it targeted ultimately at more owner-seller conversations, or is it have a broader mandate or goal, or what?
Yeah, so the goal of this podcast, the mission, I'm going to call it a mission. I think it's really a mission, is to demystify the esoteric language of M&A. That's my stated goal. And it's because, especially those sort of in the middle market and the lower middle market, this is a group of prospective sellers, of business owners, who are, I'm going to say, entirely ignored by content creators. They're not creating content to educate that huge swath of the American populace. So a lot of the content out there, this is really good M&A content, and I follow it. I engage with it. But I'm an M&A guy. I understand it, right? And there's a language that's generated, and it does happen in these industries that have some nuance to them, where you create its own language because it becomes a shorthand. That makes sense, right? So that we don't have to use these long earnings before interest, taxes, depreciation, and amortization. We can just say EBITDA.
Sure.
Oh, great. That makes sense, right? But there's a second component to it, which is sort of exclusionary, right? So, it makes it such that it becomes esoteric. So the folks who are benefiting from the services don't understand it. And that's the challenge. So they have to engage with folks like us and competitors of ours, because they don't understand it. They outsource the entire process, including the critical thinking. And I think that's a real error. So they go into this process with two hands tied behind their back. Whereas if we can educate them on what this language actually means, because the whole practice of M&A is not rocket science. It isn't, right? It's nuanced. But if we could let them behind the curtain, show the little guy pulling the levers, I think we can really open up and unlock some better outcomes for sellers, and frankly for buyers, because this, buyers have a much better experience when the seller is informed, right? Because a lot of deals, especially sub $100 million deals, even sub $300 million deals, blow up for no reason at all because of sort of communication issues that happen based upon like information asymmetry or misunderstanding. And if the seller goes in with a lot more, armed with information, armed with not quite equal footing, but understands the communication patterns and what to expect in a process, it creates better outcomes. That's my view on it. And, we're already getting that kind of feedback. We only have, I think, 10 or 11 episodes out so far. But, largely with, business operators, business owners, some of their advisors, and a few celebrities to get a little bit of action, right, to draw in their audience. But ultimately, this is going to be folks who have sold their business, talking to prospective sellers or at least business owners, so I can extract these stories out of these folks who can really speak that language that they understand.
And so if we try to generalize the content creation for business owners, because if you're an independent sponsor out there, you want to get in touch with business owners. We all know about proprietary sourcing, which you say used to be cold calling, but today maybe is direct email. But beyond that, it seems like you guys are really caught up with content creation. At Minds Capital, we are too.
Yeah.
But let's be more specific. What exactly is the content that you're looking to produce here? And also, isn't it quite situational that a business owner will care about M&A? That will only occur when they're actually thinking about exiting, right? So if you want to start building relationships and connect with them even earlier or many years ahead of time, like how can you do that? And how can an independent sponsor who doesn't have your scale pursue this path as well?
No, that's a multi sort of pronged question. I would say this: the earlier you can get communication going with prospective sellers, the better. And if the content, resonates in some way, so if I can bring on a wealth manager like I have, who will speak to, what it looks like, what you need to consider well in advance of selling your business, that's beneficial whether you're going to sell tomorrow or not. We talk a lot about business durability also on this podcast. And so, if you build your business as if a buyer we're looking, those decisions create a more durable business. Because if you're chasing growth at all costs, unless you're in the venture world, you're gonna stumble, right? I mean, you're gonna take on a contract that triples your revenue and creates incredible customer concentration, and you've got to scale quickly, and then all of a sudden that customer goes away, and you crater your business, right? So it forces you to make decisions that create a more durable business. So if I were looking to sort of get my message out there and have conversations early, I would be looking for speaking engagements. I had one yesterday morning. I have one next week. We met on a panel that I was doing. Those are opportunities. And it goes back to the thing I said earlier. Go create value. Create value in the universe, and this stuff will find you. And if you're known as someone who is educated in these topics, who can provide a real view that's perhaps different than what others are providing, and I tend to do that. I speak my mind, and I tend to stand out in that way because I don't say what the other folks tend to say. When you do that, people will remember you when it is time for them to sell. So if I'm an independent sponsor, I would be looking for every opportunity I could to put myself directly in front of prospective sellers, whether they're selling today or selling in 3 years.
Independent sponsors need a legal team that understands the model and knows the players. Platt Richmond, a Dallas-based boutique law firm, has deep experience in guiding independent sponsors through the complexities of their acquisitions. The team at Platt Richmond provides support on all aspects of your transaction, from structuring and diligence to financing and securities compliance. They also represent stakeholders throughout the ecosystem: capital providers, lenders, family offices, sellers, management teams, which gives them a unique 360-degree perspective on the sponsor model that ensures a seamless process for your transaction. Partner with Platt Richmond to focus on what you do best: finding and executing great deals. Visit plattrichmond.com today to learn more. That's Platt with 2 T's, Platt, Richmond.com.
You talk about business durability. We actually hear the opposite on this podcast from what you just quite nicely put out there. We hear that, hey, don't build for exiting. Build as if you're going to own forever, because then you're making decisions that are long-term. You're going to be more open-minded to use cash on CapEx or to innovate or to invest in people, as opposed to if you have a firm timeline, or if you are always thinking about what will an exit look like, then you will maybe shortcut some of your decisions or lower the risk on big investments.
Yeah, so I think I don't know if I misstated it or if you misheard, but I think you build a durable business such that it's going to be there tomorrow and 10 years from now. So whether you sell or not, if you make a decision so that maybe either a lender or a buyer is watching, which means, okay, do I move sort of like decision making and functional ownership down in the organization, right? Or do I stay as the person who makes every single call, as the owner of the business? Well, a more durable business is not founder dependent, right? Whether you're going to sell it or not, a better business, two businesses that are identical, and one where the leader who's 100% owner makes every key decision in HR and finance and sales and operations and marketing. That business is way more susceptible to issues than the person who has that same business who is pushed down decision making across functional ownership on multiple fronts. So I think we're saying the same thing. I look for businesses that are durable, not those that are looking for growth at all costs. And that's weird for a VC to say. I mean, I spent 10 years as a VC, and VCs chase growth. That's what they're known for. But you can make some really bad decisions when you're chasing growth at all costs.
One problem with business owners is that they don't all congregate in one place. With independent sponsors, they actually do. They go to a handful of conferences and they tune into a handful of media products. But for business owners, they're really all over the place. And as you said earlier, there are hundreds of thousands of them in the US alone.
Yes.
And so if you're trying to create content for them on a generalist basis. How do you know where to start? Which channel? What kind of content? Where do you see the highest ROI? Is it to invest in your own website and a good email engine, or are there other channels and products that you think are better?
So I think that's the right question to ask. I would say this: I wouldn't be going to ACG conferences where you're just one of 1,000. You're not looking for speaking opportunities where it's just a bunch of M&A folks. I don't look for those. I mean, I'll take them if they ask me nicely. But I'd much rather speak at an industry conference, or I'm speaking in 10 days at an economic club, where it's almost entirely business owners. There'll be 100 people in the room, business owners from across the spectrum. So that gives you, that's a direct channel. So that's not the traditional sort of deal sourcing channel where you go through advisors and try to get those sort of intros through the advisors. That's more of a direct to the prospective seller approach. You can go to industry conferences. If you can dial into 3 or 4 industries that you're really interested in, find a conference and look for an opportunity to speak. Spend money. Spend money for an opportunity to be on a panel, to stand out. So, that's how I would probably approach it, is not focus on stuff that is pure play deal stuff, because you're just one of 50 that look a lot like you. Versus when you go directly to, an industrial services conference, because that's your background, and you're, maybe the only searcher or the only independent sponsor in the room. That's different. Right? That's a captive audience, and you're not competing with a bunch of other deal guys.
And if you can bring content that is sort of that they're not otherwise going to have from an M&A perspective on their industry, what multiples are, that's right. Again, that's kind of trite or crude, but something like that, or recent transactions, or what their industry looks like from the perspective of buyers, you can very quickly in one conference sort of establish yourself as the authority on exits in that industry. I mean,
that's exactly
it does seem like a great strategy.
And you back it up with, one easy thing to do, and I started doing it probably 6 or 8 months ago. I just decided on a whim to start creating little videos on LinkedIn. And they started to build some traction. And when we put our name on the arena, Benchmark International Arena, you probably have heard of it. So I'd walk around the arena and people would stop me and say, I've seen your videos. I was like, you've seen my videos. I've put them on LinkedIn. I've got a big network, but it's not that big. And it can actually start to go viral in that regard, even without marketing it. I just do a 45-second video while I'm going for a walk, or as I'm driving, I'll do a video, and no editing. I won't even watch it. I'll post it, and it is, if you do it over and over, you start to seem like you've got something to say. And if you're targeted, so if you're really trying to create a business around it, I was just trying to sort of prime the pump for this podcast and take advantage a little bit of what we're doing in the arena, and just sort of see what was out there. But if you have a targeted strategy, these videos can be a channel 100%, and they cost nothing. Yeah. They cost nothing to create, and over time you can boost them. There's a way to boost them. I don't know how to do it, but you could do that, and it doesn't cost a lot of money. And once you can refine your process, and you sort of pivot, you add that, you parlay that with direct to business owner interactions at these conferences and any opportunities to speak. I did this 15 years ago, and I haven't done a lot of stuff in the last 12 years when I've been down here. But in my late 30s, 15 years ago, I was a prolific panelist and guest lecturer, and I did everything. I did so many speeches. I did everything, and my orientation was start with yes. People would say, "Dara, can you?" And I said, "Yes." What is it? When is it? It's tomorrow. Okay. I'm sure I have a deck for it. Let's go. I just said yes. And I got one that got me pretty good at it. You get a lot of, it's all about repetitions. And then 2, you become a very reliable face that everybody knows. So that's the strategy. It's not super nuanced. It requires a bit of grind, but you can manufacture a real sort of personal brand around something very specific if you want, if you're intentional, if you do it over and over, and you're dedicated, and you get pretty good at it. Now, you have to have some personality. You can't be a stiff. I mean, not everyone can do this, but ostensibly folks who have the chops to be an independent sponsor, hopefully these folks have come out of private equity or have been executives at different businesses, and they should have some gravitas. And if they, if they don't have that, that's a problem. Full stop. But if they have that, you would suspect they'd be able to take advantage of that skill set and that grind, and you really create something that's different than what's out there.
Dara, as an aside, your personality is you're really good at this. Nicholas and I were excited to have this interview today. Nicholas reached out to you because of your performance on the panel. So some of this, of course, is innate, but I did also just hear you say that you got a lot of reps in. So I'm curious, were you always such a natural, or is the way you present here publicly on stage the result of a lot of work? Just because for the listener who's saying, yeah, but this guy is just kind of a natural, I can't do what he does. Are they right? Or is this the result of years of practice?
Well, first of all, I appreciate that. It's always nice to hear that. I would say it's a combination. I mean, if you don't have some of this inherent, what do you, I don't want to call it charisma or anything like that. That seems so self-serving, but you have to have some personality. There's no doubt about it. And you have to be comfortable in your own skin. I tend to be a little jazz handsy. I'm also the 240-pound brown guy with a weird name. And I'm not afraid to say that. I say that at home all the time, and it just makes you memorable, right? So I'm in a sea of white guys with names that are well, we're talking to Will Smith. That's it's a name that's they're not the only one.
I feel so generic among Dara and Nicholas here.
That's right. That's right. So, but you play to your strengths, right? But we all have our strengths. But it does take. Listen, there are some people who are so dynamic that they can roll out of bed and the first time they kill it. That's a small group of people. You have to have some dynamism, and you have to have a willingness to be bad at it for a while. You just have to have some confidence that you're going to get there. Because I started over 6 months ago. I wasn't doing any of this stuff until 8 months ago. And my first speech I did at the University Club, I gave myself a D-. People who know me said it was more like a B-, C+. And the one I did yesterday got incredible reviews. I've taken off because I've gotten some repetition. So it is a combination for sure. So if you're looking to get out there and do public speaking opportunities, and I would absolutely advise these guys to do that, because again, you're competing with a bunch of other folks who look a lot like you. Then it's about repetitions. It's about taking some, what I used to call JV rooms. Like, give me a room that is really low stakes. And there might be one business owner in there or a bunch of students in there, but you know what? They're going to ask you good questions, and they're really going to ask you a lot of questions. They don't know what's not appropriate, right? Take advantage of opportunities to get out there and put yourself out there. Get repetitions, and I'll tell you, you'll get better at it. And it's not linear; it's exponential. But you have to be willing to be bad at it for a while before you get quite good.
That tip about starting in a low stakes, getting some early reps in low stakes audiences or low stakes stages is a great tip. And since we're all podcasters here and anybody consuming this content is a podcast consumer themselves, virtual version of this is podcasts. And so the way that maps on is, if you're interested in hitting the podcast circuit, start with podcasts with very small audiences, get a few reps in that way before you shoot your shot at trying to get on a larger podcast.
Totally. That's a great idea also. I mean, frankly, I should have started there. I mean, how many people do we know, all of us know, that have podcasts? And even if they're not really apropos of what you're sort of driving at, the first one I did, a couple of years back, wasn't as good as like the next one I'll do. I mean, you just get better at it. Right. And you get better and you learn. I think part of it is you learn how to utilize your voice. You learn how to not use filler words, right? You take pauses, you enunciate in different ways. You go up and down the register. That's how you draw people in. And it's practice. I don't think we come out of the womb talking like this. I mean, we get from people, right? You interact with people and you see when they're leaning in, you're like, okay, now I have them. Right. Now you can really go. Right. Or if you're trying to say something that you want them to really hold on, you pause, you slow down, right? This is stuff that it makes a lot of sense, it isn't innate. Well, for some people, it probably is, but for most people, it isn't. It requires a lot of repetition. So, and the podcast thing is a perfect opportunity. There's so many podcasts out there, and if you go on some ridiculous podcast, of course, you don't want to go on one that's inappropriate or something like that. But if they've got, if they got 6 likes on a podcast from 6 years ago, who cares? Like, Joe Rogan's not calling you tomorrow, right? So get some repetitions out there. It's all about reps.
Dara, let's pivot to the perception of independent sponsors. So where you sit, we talked about how all of your access to sellers, but of course you're in the middle of the market, so you see all the buyers as well, from searchers buying little businesses to independent sponsors to all the way up to private equity and strategics, I assume. Let's focus on the independent sponsors, and maybe to start our segment here, just kind of any hot takes on how the independent sponsors present out here in the lower middle market.
Yeah, I think that I do have some hot takes. I tend to have hot takes on almost anything. So on this one, I certainly do. It's been informed by a lot of interactions with independent sponsors. So there are some independent sponsors that I think serve a really vital segment of the market. And then there's a big swath of them that just are noise. And they're a challenge for folks like us. So the ones who lie to us and say they have committed capital, that they have LPs, that they have a fund, and aren't transparent about the fact that they are an independent sponsor, that are embarrassed by being an independent sponsor, those folks I swat away as quickly as I can. I'll go on the website and look for an LP button, look for like investor login button. If it's not there, I start interrogating. And those folks, I've had those folks tell me that they might even do the mezz. Like, we're obviously going to stroke the equity check. We've got a fund. We might even do the mezzanine. Oh, okay. Well, that's interesting. I don't know why you do mezz in this deal, but it makes some sense. Then you come to find out they don't have any money. That they have to go. That they're basically a buy-side broker that's going to shop this thing to any fund that they can find. There's a big segment of the independent sponsor world that I've seen is that. The best version of an independent sponsor is one of my favorite kind of buyers. It's just there's not a lot of them. The best kind of independent sponsor is the sort of reformed private equity person who has seen too many great deals die on the vine, too many great opportunities that, they have a $10 million, $5 million EBITDA sort of, threshold for them to even look at it. And they see $3 million EBITDA companies that are just incredible opportunities that they can't do. They can't fund those deals because they can't even get a look at it. That person who has made billions of dollars for LPs over the course of 20 years at Riverside or any of these other name brand funds, and I've talked to these guys a lot, those guys, they may not have committed capital. They can pick up the phone, and folks that they've made hundreds of millions of dollars for will fund anything they put in front of them. And that person also, so there's a problem with capital right now. There's so much capital in the lower middle market and middle market, and frankly, up market, sitting in the coffers of private equity funds. Some are giving the money back. They can't deploy. They can't deploy it. They've got some funds with DPIs under 0.4. They can't deploy this money. They're giving it back to LPs. So there's a huge opportunity here in that sort of that lower swath. If you have access to capital, you don't have, and as an independent sponsor, you don't have this sort of forcing function to have to deploy capital into deals. Well, private equity funds kind of have to take swings. And if they've swung and missed for 18 months, they have to invest in the next thing. They just kind of have to. And they have to overpay maybe to get that deal because there are others like them. Whereas an independent sponsor can stay absolutely disciplined and there's no pressure to deploy until they're ready to deploy. And I love that sort of alignment with the LPs. One of the reasons I got out of VC is because of the lack of alignment between LPs and GPs. I just couldn't stand it. And the independent sponsor model, when it's done right, has complete alignment. I only want to do a deal when I want to do a deal, not because I have to, not because of timing. So that's a great version. The other version I don't like is the guy who, is fresh out of Harvard Business School and has a novel idea of going and buying a job. And he's the only guy who has ever thought to dial up the Harvard network to get some money. I mean, when I hear that, you have to convince me that I should continue on the conversation and not just hang up. Because I've heard it so many hundreds of times, and it's kind of a joke. There has to be more to your story than that. Because every year Harvard Business School cranks out a bunch of recently minted MBAs who all have that same directory. And those folks who are wealthy, and there's a lot of them come out of Harvard with a lot of money, they get a lot of those phone calls, and they're just not taking those calls anymore, right? So there has to be some value prop. What's your unique value proposition? It can't be that you went to Harvard, because no one cares. So those are my basic views on independent sponsors, the perception.
What can that value prop be? You have mentioned industry-specific knowledge earlier. What else comes to mind?
Yeah, I think if you've sort of checked the boxes on capital formation, like, you have ready access to capital, and it's pretty clear, and you can put me on the phone. That's a great box to check that puts you on equal footing with a bunch of other buyers. I like to see operational excellence. I want to see what's the reason for you buying this company? Like, show me something, show me your plan. So even if you don't have like industry expertise, show me that you've taken something that's a similar looking value chain and driven value, and how you drove value, right? And maybe you have a sales orientation, right? And some of these companies that are sort of stagnant but are steady need somebody that can inject jet fuel, and that jet fuel is a Rolodex or strategy, right? Someone who actually knows how to take advantage of contemporary marketing techniques. Like, show me that. That's enticing. I can sell that to our clients. You have to have something that's unique about you, right? The first thing you do is you have to check that box that you have capital and you can prove it. That gives you a shot at the deal. Beyond that, you've got to show some version of operational excellence. And if it's not related to an industry, it's got to be related to some function that makes sense and is valuable.
Dara, this point about demonstrating access to capital, combined with your other point about, the quickest way to scare you off is to pretend you have capital when you don't. And independent sponsors, by definition, are not sitting on dry powder. So it is and in many ways, that is the struggle of an independent sponsor is projecting or convincing that they have the ability to close and access that capital. So for somebody who doesn't, how do they convince you and or a seller that they can close if they're not sitting on dry powder without some sort of deception, which of course is not what any of us advocate, and you see a lot and scares you off?
I think you start with transparency. I mean, for me, you get so much more credibility by telling me I don't have line of sight to the capital for this deal, but here's my strategy to circle it. Here are the folks I'm going to call, and here's why they're going to take my call. That's helpful. It doesn't mean that they're going to write you a check, but you start there. But you're going to have to focus on deals that are not going to get 12 offers. I mean, you're going to have to find these businesses that are in industries that are not, heavily consolidating. You're going to have to look for, an angle that you deliver. I mean, I always talk about angles in a very positive way. People think angles in this country, especially, like, oh, you got an angle. An angle means you've got something unique that you can create something, some alpha, some accretion because of something that the combination of that company and what you bring to the table, you create, 1 + 1 = at least 3. Right. So you have to demonstrate that, but you're going to have to find some industries and some companies that, aren't going to be the belle of the ball. And that's where a lot of the opportunity lives. I mean, if you want to chase HVAC 6 years ago, like, good luck. You're paying 15 times for, $3 million EBITDA businesses. Like, go for it. But maybe you look for something that, maybe the next thing to hit 5 years from now. But just think strategically about, like, if it's me and the way I think, I look at macro trends and I try to translate them into micro markets, right? So I look at demographics, I look at sort of where cost of capital and capital allocation is going from a macro perspective and how that sort of impacts micro industries. That's how I would think, and try to predict like sort of where these trends are, or how they're going to impact industries that people aren't excited about right now, and find a business that may not be killing it right now. Find one that's struggling, because you're more likely to find a proprietary deal there than you are in these hot sectors where you're almost always going to find a banker. And even if you find a banker in some of these ones that are struggling a little bit, they're going to be much more likely to allow you to take a swing at it. Like if we've got a business that is, struggling a little bit or is in a not so exciting industry, at least as thought of by the buyer universe, we're much more likely to take a swing or tell our client they should consider taking a swing with an independent sponsor than this hot software deal or whatever it happens to be, an industrial services deal. Like that's what I would be doing. I would not be following trends. I'd be trying to create my own.
So what I'm hearing is that independent sponsors cannot and should not compete for the A-class assets, but you should find stuff that is overlooked or ignored by others. And then you need to have an angle to repair that or create value out of that. But that is also notoriously hard for someone who is very often in their 30s and comes straight out of PE, lacks the operational expertise, or has the operational expertise but hasn't done a whole lot of strategy and M&A before. So how do you bridge that gap?
It's not an easy gap to bridge. I mean, I'd be looking at partnering, frankly. So if I'm a PE guy, if I'm a PE back guy, so 35 years old, I've spent, 6-8 years sort of growing up in private equity, and I want to go out there on my own. I would try to find a partner who's an operator, and vice versa. I mean, someone who has operational excellence. That's how I would do it. Because I think you could fill each other's gaps. And frankly, I've heard this on the search side. Some of the best search outcomes, searchers, some of their best outcomes is when it's two searchers, not one. I think IRRs are meaningfully higher in those cases. So that's what I would consider doing. But yeah, if you want to go fight after an A deal, I mean, I think it's maybe for a hero's trial just to get to go through it for funsies. Sure, go for it. You're not going to get that deal. Like I don't know why it maybe you can get a swing at that deal if it's unbanked, but finding it in an A asset that is unbanked, I mean, good luck. And if you find one, I'm going to shed a couple tears because I would wish we had found it. But those are trading at such high multiples because of all the uncertainty and so much capital set. There's so many deals set in the sidelines for years. The last couple of years, like the A's are going for crazy multiples still. So I wouldn't be looking to play there. And frankly, I don't know why. I wouldn't be looking to buy an A asset, period, if I were incredibly well backed. It's not my orientation. Like, what am I going to do with it? I mean, I guess I can grow it. I'd rather fix something and grow it. That's what I'd be looking for. So even if you're not an operator, I would take an operator's eye because that's where the value lies.
You mentioned in the pre-call that there is a correlation between credibility as a buyer and the number of deals that you've closed already. Exactly where does that inflection point happen? Because clearly it doesn't happen at 0 deals, but one deal, how far does that get you?
Yeah, I think you do get some credibility closing a single deal, no doubt about it. But someone who's closed 3 or 4 deals, they're someone that is now a known player. I mean, someone who has done 3 deals, 4 deals, I can check, even if you don't have pseudo committed capital, you have access. You didn't get lucky 3 times. You can get lucky once. When I was a VC, I never backed somebody who won the first time. I was sort of biased against that entrepreneur who killed it the first time around because I don't think you learn anything from your wins. I think because you probably got lucky. You probably got lucky and you didn't learn the lessons along the way. The person who got their head kicked in the first time is more likely to have integrated some lessons along the way and will do better the second time around. I think it's the same thing. You learn so much on getting a deal or 2 across the line. And, likely, there's probably a dead deal in there as well. So, someone who's closed 3 deals may have had 4 or 5 deals that they were under letter with. And, that person is pretty seasoned. So I think somewhere in that range, like you feel pretty confident that this person can get the deal done aside from the circumstances that kill deals that, just happen.
Just before we wrap up this conversation, so if you win a process and you get the deal under LOI, but you have a broker or banker such as Benchmark sitting there and stewarding the deal, as an independent sponsor, how do you manage the process from there? And what are the milestones and timelines that you need to hit and show in order to stay aligned and on good terms with the broker?
Okay, so what I would say is if we get a deal under letter with an independent sponsor, we are going to create milestones in the LOI. That is something we have a bias for that. And what we will do is work with that buyer as we're negotiating the LOI to establish the milestones, so that if you don't hit your own self-appointed sort of deadlines, we don't have a lot of patience for that, and you're not going to pull the little tiny violin out for you for not hitting your own self-appointed deadlines. So we're going to want to see that you have your financing wrapped up relatively quickly. We're going to want to see you start spending some money. So get that quality of earnings going relatively quickly, because that signals that you have some conviction in the deal and you have at least some of the cash, right, to get a deal done. Quality of earnings, and it costs you a minimum $25,000 and maybe $75,000 or more, depending on the complexity and who you choose to be your quality of earnings team. So, those kinds of things really do, like being open to setting milestones in the LOI that are hard and fast, that give our seller outs. Now, we don't want to give boot you after every single missed opportunity, but we want to be communicated with along the way. So don't tell us like, yeah, funding looks good. You get to the milestones, like, yeah, we don't have it yet. Just give us some more time. We want you to sort of over-index on communication. Tell us the bad news too, not just the good news. Tell us the bad news along the way so we can help you, because that is our incentive. We want to help you find that capital if we can.
And as the intermediary, how warm do you keep other buyers while you're under LOI with one?
No, it's a great question. I don't. So I don't think. I think it's intellectually dishonest. I think you trade on your reputation when you start shopping this thing while it's under exclusivity. And frankly, I don't like LOIs that don't have exclusivity, even though I'm representing the seller. I think it's harder to get bank funding. Banks don't want to do the work if you don't have an exclusive letter of intent. So, we put things under letter with exclusivity for sure. And so while we're on exclusivity, we just don't breach it. We just don't, we think morally it's the wrong thing to do. And frankly, as things get to the point where it's, the clock is ticking and it's going to end and the deal's not going to consummate and there's not going to be an extension, we can very quickly pick up the phone and call a backup buyer. So, I'm not too worried about that. In 90 days, that buyer is not going away usually. So we just don't do that as a matter of course.
Dara, give us the name of the podcast one more time before we let you go.
Absolutely. Appreciate that. It's called Closing Remarks by Benchmark International, and you can find it on all of the platforms that you would consider. It's on YouTube, it's on Spotify, it's on Apple. I think it's on Amazon as well.
Great. Well, we'll put a link to that or the title of it as well in the show notes. You're linked in too. Dara Shareef, Benchmark International, thanks so much for joining us on Minds Capital Podcast.
Thanks, guys. I enjoyed it.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital Podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.